What are we doing with trusts? Do we still recommend trusts? Are they a viable investment structure? What about a bucket company? Would you still use that? What if someone doesn't have one right now? Would you recommend it? What if they do have one right now? Would you still recommend it? If you've got a trust, if you're thinking about trust right now, I suppose if you've got a trust, like really nothing needs to change. I think, and the message was to our advice team yesterday, is if you're looking at maybe investing through a trust and you're not in business, I suppose, in particular, would you go and open a trust right now? That's where I think a question mark should be around going and incurring costs and setting up a trust and a bucket company, because unless you need it for business purposes.
Well, so you got a small business, let's say it pays 25% tax, but it pays a dividend, goes to a family trust. Family trust under the new rules would have a minimum 30% rate, so there's going to be an extra 5% paid there. You get it from 25 to 30. Then you send it to a bucket company. The tax credit doesn't flow through, so the bucket company pays 30%. Right? So that's your 51%, someone calculated. So 51% tax has been paid. That company
All right, welcome back to the Winners Playbook. Josh here with Billy. Today we're going to be talking about what could be one of the biggest investment stories we've ever seen, the SpaceX IPO. And for everyone listening, anyone out there who's got a superannuation fund, for the most part, you are going to own a little bit of Elon Musk in the not too distant future. So this is not just another company listed on the stock market. Reports suggest SpaceX could become the largest IPO, so that's an initial public offering, in history, with a valuation that would put it among the biggest companies in the world. And here's what the interesting part is. Even if you never go out and buy SpaceX shares yourself, there's a good chance a lot of Australians could end up being exposed in some way through superannuation, ETFs, managed funds, or index funds. So this episode is not about whether you should buy SpaceX. It's about what happens when a private company becomes a public company, how that flows through the markets, why investors get excited, and why the return you see on paper is not always the return you actually keep. We're going to be talking about the hype, super, index funds, capital gains tax, the fallout from the budget, ETFs, investment bonds, trust, bucket companies. I don't know what else more we could squeeze in there, Billy. But there's obviously lots going on, and we're going to unpack that, a bit of the fallout from the budget, Billy. But before we get into it, mate, what's news on your end, mate?
What's going on? Well, I think we've probably covered this before, but I'm experiencing the single parent life as my wife's popped up to Brisbane to see her family.
Yep.
So I'm here with two primary school aged boys, making lunches, tidying up.
Yeah.
Don't
envy you.
No, oh mate, it's intense. And I was just sort of like, what would you do? Like if you didn't have your partner there, like you need an au pair or something. Like you can't do it yourself.
No.
Not full time.
No.
Yeah, not we can, but it sucks.
Yeah, well, that's actually, it's not a topic we're talking about today, but that's actually why I talk to a lot of clients around, like with their insurances. Like for a lot of clients I work with where they're both still working, got young kids, got mortgage and everything there and in between, one of the considerations is if something happened to the other person, it's not necessarily just about like clearing debts from an insurance perspective, but it's also like you're going to lose that income, and then you as the surviving spouse or who's still providing, if you've got young kids, you might have to take a step back from your job possibly, and then your income is therefore then going to drop, or you're going to have to hire a nanny or some sort of support to give you a chop out. So I know it's an unrelated topic, but it just makes me think about that, and something I always talk to my clients about when they think.
Yeah, well, we could tie it into what we're talking about today, which is higher taxes on everyone. Because if you're a single person or a low income person, life's tough.
Yeah.
But if you're trying to raise a family at the same time, it's really tough. So
yeah, no, definitely. Well, I'm not in that sort of boat at this point in time, Billy. But I was going to say Leon. Well,
did include son out.
Well, it's funny though, because he's starting to say his name. So we say, who's that? He's like, Daddy. And then we say, who's that? And he's like, Eon. That's what he says. He can't say L. But a spit off of that is you can actually spell Elon out of Leon if you just play those letters around. So
was that by design? Or?
I don't know, maybe, but here we are. We're talking about SpaceX and Elon Musk as well today. But yeah, lots going on. I've been looking pretty closely at our housing situation at the moment, and I'm obviously very jealous of you living really nearby the office, and I've seen you just walking in a few times, and I get a little fired up seeing that, Billy. Watching you just walk in from just around a corner from your home, and then I've had some savage drives home lately. Was it last week where I literally left the office, I got to the Burke Road, I was on Burke Road down to the Monash, which is what's that? Maybe within 10 kilometers from the office, and I was about 45 minutes to that point in the car, and I hadn't even hit the Monash. So I think that journey was about an hour and 15. So, I'm definitely weighing up what we do from a housing situation, but I talk to my clients all the time about this stuff. You sometimes you get like a little bit hyped up in the moment and the emotion, and I get home like, oh yeah, traffic and all this and that, but I'm just trying to cool my jets and weigh up all of the options, because selling or buying property, renting again, there's a lot that goes on there and in between. So I'm trying to take my own advice and just take it cool and play it cool, and not make any sort of knee-jerk reactions here. But very jealous, Billy, I won't lie.
No, I mean, you're always second guessing your decisions too, especially with housing. Like we went from owning back to a rent vesting type strategy.
Yeah.
And first 6 months, you're like, yep, this was spot on. This was such a good decision. But then when it came up to lease renewal, I was like, oh man, I do not want to have to move house.
Yeah.
And trying to find a rental around here, as you know, expensive and difficult.
Yeah.
Just a few days ago, we got told we got another 12 months. So
Beauty.
Thank God.
Beauty. The rent didn't kick up too much, or?
Oh, they tried to jack it up as much as they could.
Yeah, really.
I pushed back and we got to compromise.
Nice. Yeah, that's good. It's kind of feels like you're running the gauntlet a little bit there when you're renting, when that time comes around.
I know, because I keep looking at other rentals and I'm like, oh, there's not much.
Well, glad your lease has been renewed for another 12 months, Billy. Really happy for you, mate.
Stoked on that.
Well, let's dive in. So SpaceX IPO, Elon Musk, everyone is basically going to become an investor in Elon Musk and what he is doing, if they're not already, through the exposure with Tesla. But do you want to talk a little bit about what's going on with SpaceX? And that's looking like it's basically going to be the biggest IPO ever, a company that's been taken from private to public. So yeah, what's happening there, Billy, and what do we need to know?
Yeah, so this is a fascinating story, and it will affect everyone, which we'll get to in a minute. But essentially, SpaceX to now has been privately owned. So there have been ways to invest in it, like essentially through private equity funds and things like that. Why did they stay private? It's because they don't have to deal with all the regulation that's involved in being a public company. You don't have to deal with having shareholders, like public shareholders. So you stay private, it gives you more flexibility and so on. But from what I understand, the main reason they want to list is that investors want liquidity. Like once you're publicly listed, and you can buy and sell shares easily. So they want liquidity, and then as part of listing, they'll also raise capital. I think about 20 billion they're trying to raise, something like that. So that's why they're listing. But what's interesting is they're trying to list at an insane valuation of nearly $2 trillion. Now, this is a company, their revenue last year was 19 billion, and they made a loss of 5 billion.
Wow.
And they're saying their company is worth $1.75 trillion.
Jeez.
Now, I dug in, I'm like, how do they get to this valuation? How are they going to get away with it? So this is a classic Elon Musk situation, like promising the absolute world. So he reckons SpaceX have a total addressable market of $26 trillion. So he's saying essentially their growth path, like he's essentially saying they're going to be worth many, many multiples of $2 trillion in the future because of the products and services they're building. The vast majority of that is centered around having orbital data centers. So just data centers like satellites, like floating around the planet.
Right.
And he's saying if we do that, we're going to sell trillions and trillions of dollars worth of these data centers.
Interesting.
Like his capability. So that's what he's claiming. And so what's interesting is it's going to come in at $2 trillion. That will make it a top 10 company, like top 10 companies in terms of how big it will be. So up there with Microsoft, Apple, Nvidia, which means it will be slotted straight into everyone's index funds, whether you like it or not.
Yeah.
And I looked up, so what percentage of the market is that? That's estimated to be 2.5% of the S&P 500.
It's huge. That's huge. So can you explain to me what happens in that scenario? So like how the ASX 200 or the ASX 300 works, or say the S&P 500, which is the top 200 or 300 or 500 companies by market cap. So then to slot in SpaceX, someone's got to get out of the S&P 500, yeah?
Yeah, so what's the S&P 500? It's the 500 largest companies listed in the US. And index funds, like if you're investing in an S&P 500 index fund, you obviously own shares in those 500 companies weighted by size. So the operators of those index funds, they're constantly re-weighting what shares they own within that fund. So if a new company comes, an emerging company comes in and it gets itself into that top 500, the index fund has to buy shares of that company. So if SpaceX lists and it's worth $2 trillion, then all the index funds have to start buying shares in SpaceX.
Yeah. When SpaceX in, someone else out.
Someone else out.
Someone else pushed out.
Yeah, so yeah, there'll be selling that goes on as well. But if you're thinking, well, I don't buy index funds, well, you probably got them in your super.
Yeah.
So we could have a scenario where all the biggest super funds in Australia all have shares in SpaceX in the mix. So the question is, in a year, 2 years, 5 years, is SpaceX going to be worth 5 trillion, 10 trillion?
Yeah.
Or is it all BS and it's going to crash and drag the index down with it?
Yeah, and I reckon we've both seen, our fair share of clients. I think I'm trying to think of one company where I've seen individual investors take high conviction around, and it's been Tesla and Elon Musk. I know you've had some, and I've definitely had some clients over the journey. Some of those I've worked with, some of those I haven't worked with, who have just backed the truck up and put a lot of money into Tesla, and virtually just on the hopes that Elon Musk, pulls off and stays alive. Like the key person risk in Tesla and SpaceX is just astronomical. I can't think of any other company that's probably on the same page or on a similar level to them.
Yeah, I mean, Elon's driving it all, right? Like, it's a bit of a cult. And, to his credit, yes, he's created the largest space company, right? Launched hundreds of satellites into space. He's created Starlink. So that's where most of their revenue comes from at the moment, is Starlink.
Yeah, right.
So part of it is growing that. But Starlink alone it's not worth $2 trillion on just Starlink.
Yeah.
No matter how big that gets. So it's pretty much all based around this data center concept.
Was there anything in there about getting to Mars, or how that's going to be profitable?
I'm not sure.
There's got to be something in the fine print there.
Well, there was another wild thing in there where they're saying, they're rockets like Falcon X, whatever it's called. Be able to like jump on one of these rockets to go from like London to New York in 20 minutes.
Hey, I'd like to see it.
Yeah, it'll be cool. I don't know if it's real, but
yeah. Well, if anyone can do it, it's probably Elon. So.
Yeah, exactly. Yeah.
Well, the parts I suppose to add to that, because I think you've covered it off pretty well, but I was doing some videos a little while back around when the IPO sort of got floated, and there was a fund, because you mentioned up until this point, or until it IPOs, pretty much not many investors, the average investor can't get exposed to SpaceX in any way, shape or form. But you could through like private equity funds, and that's a space that we are starting to play in ourselves and get some clients exposed through. But there was a fund, and I did a couple of videos on it, called Pengana, and that was like a private equity product that you could use here in Australia. And they'd actually invested back in SpaceX in 2020 when SpaceX was worth about $40 billion. $40 billion SpaceX was worth. And what did we say they're possibly listing for? 1.75 trillion?
Yes.
So do the numbers on that. They've invested when it was worth $40 billion. And I understand that they've put in roughly about $40 million at that point in time. So that was only one of the investments in their portfolio, but naturally, because the valuation has gone through the roof, it's now grown to actually quite a sizable portion of their portfolio. And I'm sure, their returns have, shot up based upon that. But there are some investors in Australia that would have been exposed at these earlier stages, and are then going to reap huge rewards if this thing does in fact then list at 1.75 trillion. But all along the journey, like you were saying, I suppose there's pretty much very minimal, if any, liquidity at that point in time, and hence a lot of those investors took on a risk investing at that point in time, and I suppose one of the lucky few where it's actually going to pay off once it lists, and probably time to take a bit of money off the table. But I believe Elon Musk is actually still going to, I haven't looked at the exact amount of shares that they're actually going to be carving off through listing. Do you know what
I don't have that down here, but yeah, he's retaining a huge
Yeah,
Huge shareholding.
and I believe the way that it gets structured, like I'm not fully across how some of this stuff works, but there's different classes of shares you can issue in companies. And my understanding is, although he owns a portion then of the company, still a large portion, but I think he has then like controlling, say, because he has these like, I'm not going to say it right, like super shares or shares that have way higher voting rights and power, even though he doesn't own like 80% of the company. It takes the shares that he have these powers within, so he basically will still just control the company, even though there's all these other shareholders within and there's a board and everything like that. I'm sure it's around 70 or 80%, and he just has like control and voting rights still. So you're really betting on Elon Musk is what you're doing,
and we're all going to be betting on him in our index funds, whether you like it or not. So
we are. Well, that's an interesting one. So I suppose watch that space. But if we pivot away from Elon Musk going to Mars, that's a topic for another time. Talking about some of the fallout from the budget. So we were chatting before, Billy, around, you did not a podcast, but you were doing a talk with an accountant recently on some of this around the actual tax rate on shares based on these changes coming through in the budget. And in some situations, depending upon how the numbers look and what you buy for and what you sell for, the tax rate on those shares could actually exceed that of 50%. And we're not even talking about for bucket companies, which is something we'll get to a little bit later on, where it will actually exceed 50%. It is a little bit confusing to understand, and we could actually put the diagram that you've done up maybe in the show notes as well, or a screenshot, so people can actually see these numbers. But do you want to walk us through that? And in simple terms, what does that mean because of the proposed changes here?
Yeah, look, this one is hard to talk through without a table and numbers in front of you. Mm-hmm. But on a high level, okay, so at the moment we have this 50% discount, right? So let's say you own shares in 5 different companies. One of them does really well, the other ones don't do so well. You sell the whole share portfolio. There's a tax calculation that goes on, and essentially it comes out with what was your overall profit, what was your capital gain. So you've got the stock that did really well, made 50 grand. You've got some other ones that was losses. That's all offset. Then what was the net gain? And you divide it by 2, and then you put that number in your tax return. That's taxed at normal income tax rates. That's the current calculation. What they're looking at moving to is similar to what we had in the 90s, where we've got indexation. So you invest 20 grand into a stock, you sell it 10 years later, you make a profit. When they calculate what the gain is, they'll index the cost base. So if you invested 20 grand, that's going to increase along with inflation. Then they're going to say, okay, well, your indexed cost base is actually 28 grand. Then calculate the gain from there. Under this new system, however, when you go to offset losses, so if you have other stocks there where you've lost money, there's no indexation there. So you can only use the real losses. You don't get to like index things. And what it all means, without diving into all the numbers and details, what it all means is you can't use all your losses because they're not indexed, but your gain is fully taxable. And so when you run this model out over, let's say, an investor who has 5 different stocks and they got one big winner and the other ones are either losers or didn't do so well, you can end up paying this very, very high rate of tax because of the way that indexation works. So at the end of the day, it's just so complicated. And you question how this is going to be a better system than what we've got at the moment.
Yeah, so in a way, like in simple terms, trying to describe that, because even when you were explaining it to me in the morning, I'm like, all right, I got to see some of these numbers to understand and wrap my head around it. So it's kind of like they're taxing fully on the gain, and then the loss is kind of being diluted and watered down in a way, and you're not getting the full benefit of it.
You don't get to use the loss at all unless it's what's called a nominal loss. So there's no indexation benefit, right? So if you invested 20 grand into a stock and then sold it 20 years later for 30 grand, after accounting for inflation, you haven't actually made a day. That's actually a loss after inflation. You don't get to use that for tax purposes. So that's pretty much ignored. And then if you've got another stock that you did make a big gain, you're just going to pay full tax on that.
Yeah. Well, I think that's a good way to summarize that, because that hasn't been talked about in I haven't heard anyone really talking about that thus far whatsoever.
No, I mean, given that it took, I had to sit there and run spreadsheets and articles, and I mean, how is somebody who's not a financial advisor or an accountant or something is supposed to even wrap their head around it.
Yeah.
Because where it's all going to land is you're just going to be told, look, just buy an ETF. Because if you buy, let's say, an S&P 500 index fund, within the fund, they're going to offset losses and so on, and then they're just going to spit out the net gain to you to pay tax on. So you won't have to worry about all individual stocks and what's a nominal loss, what's a real loss. This is going to be far easier. No, just buy an ETF because the tax calcs are so complex that if you're running a share portfolio, before you sell anything, you're going to be second guessing, what's this going to do to my tax? I don't even know. You're going to have to try to apply inflation rates to different cost bases. It's just extremely convoluted. So certainly hope it's something that the government backs down on because it's crazy complex. And can't see why they'd want to go down this path.
I think most people just don't actually understand what a real return on their investments actually is. Not even thinking about what the budget proposals were, but thinking about what a true real rate of return is. Because I think that's what people tend to forget with property is not just all of the costs they're paying along the journey, but then, and not just property, with shares as well, like factor in, say, long-term inflation between 2 or 3%. Whatever your headline return is, you got to take away your taxes, whatever your taxes and other fees and costs that you're paying, and then strip away another 2 or 3% to allow for inflation. And that's really, what you're making. And we use that example a lot with a high interest savings account. Say you get 5% rate of return on your money, take away taxes of say 47% if you're in the highest tax bracket. That's bringing you down to 2.75% return on your high interest saver. If inflation is 3%, you've actually lost money on a real basis. And I think so many people forget that with their shares. Like the example you just said there of you buy a company at $20,000 and then in say 15 years, it's worth $30,000. Like on paper, you're going to look at that and go, I've made 10 grand. Like how good is that? But when you index up your cost base, you've actually, depending on what inflation, of course, has been over that period of time, you've actually lost money. And I don't think anyone would really ever think about that whatsoever. And the government clearly isn't making any allowances for that in what they've proposed. So
spot on. And then we haven't even spoken about dividends and income, but clearly that's going to be a huge part of the formula because income's not going to be treated as harshly, or like franked dividends won't be treated as harshly as capital gains.
So I guess really taking all of that into account, Billy, then it really is pushing, I think, a lot more investors to think about ETFs, the direct share trading, pushing away from that. But, we spoke about one of the winners from the budget being investment bonds as well. So this all relates to the topic of what we're actually talking about. So do you want to try and talk through in simple terms and, how an ETF or particularly an investment bond, how they can actually manage the ins and outs of, selling and buying companies within, and the effective tax rate can actually be a lot lower than what you think, and how that works?
Yeah, so like this budget on a high level, they're really trying to make sure no one's paying less than 30% as a tax rate. So, and the example we just spoke about with direct share investing, when you figure out the capital gains and how complex it is and convoluted, the tax rates a lot of the time will be a lot higher than 30%. So that brings us to a solution which has been around for a long time. The vast majority of the population doesn't even know these things exist. And those are investment bonds. An investment bond, when you set one of these up, it's got a menu like you'd have in your super fund, like you got high growth balance, you might be able to use index funds, all that stuff. So you put money into the investment bond, you pick how it's invested and build a portfolio there. It's taxed internally at 30%, at a maximum 30% rate. So like similar to a company. So nothing goes into your personal tax return when you use a bond. It's all taxed internally. The rate's 30%. CGT discounts, whatever, aren't relevant. It's all 30% rate. But the thing with these bonds, if you hold them for more than 10 years, there is no tax after that point if you then want to withdraw and take your money out. So you don't get that big CGT hit at the other end when you go to sell. So these bonds, like we use them, right, for investing for kids. People who are on really high tax rates will often use bonds. But with these CGT changes, the bonds can become way more valuable and I think way more popular moving forward.
I agree. And, there's obviously a lot of investment bond providers out there in Australia as well. And they're all quite similar, but do have, different investment menus. But I think that the best part of an investment bond is really they're so simple. And like you said, you don't actually have to declare any of the income from the investment bond year to year. So if you've got your regular investment portfolio, the income generated has to be declared on your tax return every single year. Your accountant's going to ask for a tax statement every single year. That has to go to the ATO, determine how much tax you pay, add back franking credits and all of those things. But yeah, with an investment bond, if you don't touch it and withdraw any money from it, there is nothing to declare from an earnings perspective. If you are to withdraw from the investment bond, though, it's worthy of noting, then there will be some earnings that do get added to your taxable income. And then once you get up to year 8 of owning that investment bond, that actually starts to come off. And then by year 10, you're virtually in tax-free territory. But yeah, I think a lot more people are going to push towards and look at investment bonds. Just also the flexibility of it, because you can change ownership and structure of them as well. And it's also not a taxable event. So if you're investing in your name and you're investing in whatever the portfolio may be, say you want to change that to a trust, that's not a taxable event. Say you want to change from an Australian share portfolio to an international portfolio or high growth to whatever it may be, that's also not a taxable event because it's all taxed internally. And one thing I think people also miss when they're using and investing via ETFs is some ETFs, like if you look at ones that a lot of people would always know is like Vanguard. Like who doesn't know Vanguard? And I think if anyone comes through and I say, what are you investing in? They've probably got a Vanguard product in there somewhere, some shape or form, an ETF. But a lot of people don't realize that some of those ETFs and funds, although they're, high growth portfolios, sometimes they can actually do a lot of distribution because they're, selling like say a S&P 500 tracking index or a ASX 300 tracking index to make way for SpaceX coming in, something that's sold and coming in, and therefore, so they're realizing gains and their taxes and so on and so forth. And then they manage that, and that then comes out in a distribution. And I remember we were looking at one of the Vanguard investment options a few years back, one of their high growth options as well. And you would think it's basically just got shares in it. That's all it's got in it. So you'd be like, oh, you're going to be getting most of your return from growth. But it was actually the income that was actually providing a much greater part of the return. I think it was about 5 or 6% income that the investment option was actually generating. But when you look at it on a headline, you'd be like, no, that's a growth option. I would be getting more growth, but no, you're getting the income, and then you are going to be taxed on that income. But I suppose the beauty there is you don't have to worry about any of the calculations and things that we were just talking about then. It's all managed internally within that fund because you're not stock picking.
Yeah, because then with that income, part of that is gain. Right? Like part of it's underlying like dividends companies are paying. But then because the portfolios had some turnover, buying and selling, there's a gain, and they send that out to you as part of the income. Mm-hmm. So under these tax changes, that tax statement's going to be a lot more complicated. It can be indexation and so on built into it. Yeah. Which leads us to the investment bonds and how that'll be a lot more of a simple tax structure.
Mm. And investment bonds, I see that they're used by everyone. Like we've got some clients with some large money, that are in their 70s and 80s that are using investment bonds because it's really, I suppose, one of the better alternatives when you're maxed out with superannuation. Where's the next best sort of house to start putting some money in? We'll talk about, companies and trusts in a moment because the government's basically trying to destroy those in a way. Really, what else are you left with?
That's it. And on bonds, what are you doing tonight?
On bonds?
Yeah.
Oh, you mean heading to one of those events?
Yeah. Are you too?
Yeah.
And we're going to competing bond provider.
Are they doing that deliberately or what's going on?
So all the investment bond providers they're probably the most excited about these tax takes. Probably the only people that are excited.
Yeah.
And so they're hosting dinners and events and spamming us with emails.
So what have you got? Yours? What have you been?
I don't know if we can say product name.
No, we won't go product names. But have you got some speakers? They've got me in with some speakers and
mine's being referred to as an intimate dinner.
Intimate dinner. Interesting. Well, I think on ours they said to wear something that was a bit groovy or you feel comfortable with. But I'm just going in the chinos and the white shirt. So I'm not
probably wearing this.
I'm not embracing it. But like investment bonds definitely on the radar. And if we go along with that topic, I suppose we were actually talking about this yesterday in our advisor training session that we do every week with all the advisors in the business. A lot of chatter around what are we doing with trusts? Do we still recommend trusts? Are they a viable investment structure? What about a bucket company? Would you still use that? What if someone doesn't have one right now? Would you recommend it? What if they do have one right now? Would you still recommend it? And I guess the key message here, and this is not just from us as advisors, but speaking to tax professionals and accountants that look after this stuff day in and day out, nothing's legislated right now. I wouldn't be making any changes at this point in time until you see the devil in the detail and it actually passes through. Because again, I'm happy to go out on a limb and think, I will say, like, I think some parts of what they've put towards trusts and bucket companies, I think will get watered down. The amount of pressure I'm seeing from the business community, like everyone is fired up about this, particularly, in the startup, the founders space as well, whereby, you risk everything, you're with the hope that you're going to, it's going to pay off and you're going to make some good money out the end. But then now you're looking down the barrel of, some of the highest taxes around the world. And, I'm sure everyone probably listening has seen some of those memes of Alvo owning 47% of your company. But I wanted to maybe clear up a little bit around that. So I guess if you've got a trust, if you're thinking about trust right now, I suppose if you've got a trust, like, really nothing needs to change. I think, and the message was to our advice team yesterday, is if you're looking at maybe investing through a trust and you're not in business, I suppose, in particular, would you go and open a trust right now? That's where I think a question mark should be around going and incurring costs and setting up a trust and a bucket company, because unless you need it for business purposes, I don't know, or maybe you're investing a lot of money as well. It might be a matter of just a wait and see. So maybe you just invest an investment bond to begin, your personal names to begin, and just see where things pan out here. But the one I really want to talk about is that the bucket companies, where they are virtually getting destroyed through the budget. If these changes go through, like, the government is murdering bucket companies at this point in time. They will not be favorable in any way, shape or form, where you put money through your business or you have income coming in through your trust, and then you send it down to that company and you get a capped 30% tax rate, but you do get the franking credit offsets in there as well. Whereas basically what the government is doing is, as we know, trying to cap put a minimum threshold of 30% tax on trusts. But then if you send money down to a corporate beneficiary or a bucket company, 30% headline tax, but then you won't get the franking credits as well. So if 25 or 30% tax has already been paid on that money, you won't get a franking credit offset for that. And that virtually pushes the tax rate of a bucket company over 50%, which is, no one's who's going to want to distribute down to a bucket company. It's gone.
Yeah, this is how it works. So you got a small business, let's say it pays 25% tax. That it pays a dividend, goes to a family trust. Family trust, under the new rules, would have a minimum 30% rate. So there's going to be an extra 5% paid there to get it from 25 to 30. Then you send it to a bucket company. The tax credit doesn't flow through. So the bucket company pays 30%. Right? So that's your 51%, someone calculated. So 51% tax has been paid. That company, the money's now in this bucket company, that then pays a dividend to the individuals now. If they're on the top marginal rate, they'll pay more tax. So it brings it to like 70%.
Yeah.
So no more bucket companies if that all goes through.
No, and I know a few people with bucket companies, and I'm one of them. I think that could possibly get watered down. Like, the mechanics of how they're going to administer that, God, who knows? And I think importantly to note that of all of the changes, like, I think everyone agrees that negative gearing is going to get, changed, and that's going to happen pretty soon. But they've put out the date for trusts to 1st July 2028. So I think of all of the budget changes and proposals, I think that might be one of the ones right towards the back end. So they're clearly giving themselves a runway to consult the business community, the tax community, or with accountants and so on as well, because I don't even think they fully know how they're going to administer that one year to year. And then they're leaving this, they've put in there that businesses or trusts are going to have until June 2030 to restructure their entities. So and again, the wording around this is minimal to none in terms of there's going to be some rollover relief for entities till June 2030, so that if you've got a trust or a company, you want to restructure it based on these changes, it seems like you're going to be able to do it and maybe not pay tax at all, or restructure in a way to get ready, and which would basically just be a lot of people moving to a company structure and maybe getting out of their trusts. But a lot to still figure out where that falls in.
With the rollover relief, the one area I would be really careful is property, because if, let's say the government says rollover relief, you can move your assets from a company to a trust or a trust to a company, whatever. But if you have a property, there's stamp duty, which is state-based.
Yes.
And, we live in the great state of Victoria.
Oh, yeah.
I think they'll go, oh, sweet, we're going to get a bit of extra stamp
yeah.
duty here with these restructures. So you wouldn't blaze away and buy a property through a trust or a company until you really understood what these changes might mean.
Yeah, no, it's a really good point. But you'd like to think if it does go through that has to be a consideration, because then if everyone's going and restructuring all of these assets, and then there's all this stamp duty that's being incurred, like, again, then no one's going to want to do it. Of course, if you're then going to hand over whatever it may be by way of stamp duty. But I think that sort of just talks to as well, getting your structures and entities right from the beginning, or what name you're going to be investing in, is just so crucial. And it's always one of the first things I talk about with my clients is around, first of all, what have they done now? Because you generally can't unwind it. And I've seen some horror stories over the years of properties, business owners just having multiple properties in their own name, all into one state. They're paying land tax through the roof. Asset protection is non-existent because it's all in their own personal names, and they're in like the building sector, which is quite high risk. And then they go, oh, hey Josh, can we just change those assets over to a trust now? And it's like, yeah, well, you could, and you're going to pay capital gains tax on that, and then you're going to pay stamp duty on getting it into your trust, or the other entity as well. And who wants to do that?
Yeah, we had an interesting case recently just on, don't react too quickly to changes. We had a client, their business is operating through a trust and it made a massive profit last year and probably will this year. So we're considering bucket companies, because even if we do 2 or 3 years of distributions to bucket companies, that even if there's changes come through, it'll still be worthwhile in the exercise. So the point is, it's like real specific to your situation, whether you change things or not based on what's being proposed.
Yeah, and that would make sense. Like, if you've got a couple of years runway here, you could still take advantage.
Somebody's in the bucket company, even with changes, you should be okay, because it's sitting in this company with the franking credits in there in. All that distributions that happen after 2028 is where you could, the whole strategy could be completely unviable. Yeah,
and I guess like most people commonly in their bucket company would start buying properties or investing in shares or even investing in startups. Like, that's commonly what people do, is they siphon money out through their trading entity to their trust and then get it down into the bucket company to start deploying that. But how's that all going to unwind? I've absolutely no idea at this point in time. So we'll wait and see where all of that lands. But I guess the important message there is no knee-jerk reactions, and nothing's changed at this point in time. So in all of our planning and what we're doing, like, we're definitely thinking about it, but like I said, for the most part, there's still some years to go here where some of these strategies are, of course, still incredibly viable and beneficial. But besides that, Billy, I think we've covered off on most of our topics that we had for the day. Is there anything that we've missed, or any other notes that you had on your end that we haven't hit?
No, mate. But after our events tonight, maybe we'll get a bit more into some of the investment bonds in a future pod, because I think they're going to be really valuable.
Investment bond special, you think?
That's it.
Yeah, all right. We might leave it at that. I hope everyone got value out of what we've been talking about, and we'll see you on the next episode.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.